Hey everybody, Andy here with Twisted Finances. In today's video, we're going to be talking about index funds, mutual funds, and exchange traded funds, or ETFs. We'll be looking at the similarities and the differences, as well as the pros and cons of each type of fund. Before we get into the specifics of each type of fund, I just want to cover the basic similarity that they all have. Whether you have an index fund, a mutual fund, or ETF, they all provide great diversity for your portfolio, which is something that you should always strive to achieve. Each one basically is like a basket of goods that holds all of these goods, and when you invest into the fund, you essentially have your hand in each little good inside of that basket, providing diversity. But of course, there's pros and cons that come with each type of fund, which we're going to cover now. So the first type of fund I want to discuss are mutual funds. A mutual fund is a type of financial vehicle that pools money from all these different types of investors to invest in stocks, bonds, money market instruments, or any other type of financial security. Mutual funds are professionally managed by money managers that strive to achieve capital gains for their investors. So starting off with the pros of mutual funds, one pro of a mutual fund is the liquidity. Now the liquidity is not as liquid as the other funds that we'll discuss, because mutual funds can only be bought or sold at the end of a trading day. So if it's intraday trading, you're not able to sell your mutual fund, but you still can sell it basically every day, which does provide a short-term liquidity if you ever incur solvency issues in your personal life. The next one is what I kind of discussed before, was diversification. It's because all of this money is pooled together and it is invested in different types of stocks, bonds, and all these other type of financial securities. The next pro about mutual funds is it has minimal investment requirement. Now there are mutual funds out there that require $10,000, $20,000 upfront investment. We're not really going to talk about those. You can get in on mutual funds with as little as $100 on some of them. So they do have a low barrier for entry. The fourth pro of mutual funds is the professional management. There is somebody that is actively managing that portfolio and trying to make you money, which is awesome because it takes all the grunt work off of you. And the last pro of mutual fund is the variety of offerings. Whether you're investing in a mutual fund that primarily invests in stocks or one that primarily invests in bonds, there's a whole bunch of different mutual funds that you can pick and choose from. So it really gives you a great catalog to choose from. Now we're going to talk about cons of mutual funds. And the first con is the high expense ratios, the management fees, and everything like that. Since they're actively managed, you do have to pay the manager that is making you money. So typically mutual funds charge a higher expense ratio. All mutual funds come with a different expense ratio, but I think you can kind of expect to pay anywhere from 5 to 10% a year on annual investment fees. But like I say, it changes and is different for all mutual funds, but you do typically have to spend more for it to be actively managed. The second con is that mutual funds tend to have large cash in their portfolio. And you might think this is good because they're rich, but if they have a large amount of cash sitting in their portfolio, that cash is not doing anything. It's not generating income. You're losing out on potential returns because they're hoarding cash. We don't like that investment. We like to spend all our money in the market so we can make all the money that we can. The third con about mutual funds is that they're not FDIC covered. So as you know, banks are FDIC covered up to $250,000, essentially meaning if that bank goes bankrupt and you have less than $250,000, you still will be able to get that money that is covered by the government. Mutual funds don't have that, but it's not really expected. It's the stock market. If you lose your money in the stock market, you're not going to get it back. So it's kind of typical, but it is a con of mutual funds. The fourth con of mutual funds is that it's difficult to compare different funds because one, they have different managers. So they choose different paths on their mutual funds. And a lot of mutual funds are invested in a lot of different things. So there's not really a apples to apples type comparison. You kind of have to compare apples and celery, if you could even do that. And the last and final con of mutual funds is just the lack of transparency of holdings. Now, mutual funds do give out prospectuses and they do talk about what they want to invest in and what they're currently invested in. But in terms of actively having that information to all the investors, sometimes it's hard to find. Sometimes you only get the prospectus, so maybe a semi-annual or annual prospectus, but besides that, you don't really know what's being invested in that fund. That covers mutual funds. Now we're going to talk about ETFs, exchange traded funds. So an ETF is a type of security that typically tracks either an index, a commodity, a sector, or any other type of asset. And ETFs act a lot like stocks because you can buy them intraday trading. At any time you want to, you can buy and sell on the stock market, just like a stock can, but it's an ETF. So it's a fund that has its hands in all these different types of securities. There's so many options when it comes to ETFs. They can be structured to track an individual price of one commodity, or they can be structured to track a large and diverse amount of stocks or commodities. ETFs can actually literally be structured to just follow a popular investment strategy, like Warren Buffett's investment strategy. An ETF can be set up to follow what Warren Buffett does. So starting off with the pros of ETFs, the first pro is that it gives you access to many stocks across many different industries, many different sectors. This is because it's just like a mutual fund, you this basket of goods that has all these different types of stocks. So when you invest into the ETF, you're investing in all these different types of stocks, therefore providing diversification. The second pro of ETFs is that they tend to have lower expense ratio and lower commissions. This is because, and this is different between all ETFs, there are actively managed ETFs, so they do have higher expense ratios. But a lot of the passive ETFs, meaning that they are not actively managed by a manager, have incredibly low expense ratio. Some of the Vanguard ETFs have as low as 0.03% expense ratio. The third pro of ETFs is the risk management through diversification. Kind of ties in with the first pro, but really more in of it is that ETFs really do provide just a vast diversification if you get into the ones that have 10,000 stocks or 15,000 stocks. I mean, if one sector goes, you'll be okay because you literally have every single other sector. And the last pro that I want to talk about ETFs are the ETFs that focus on targeted industries. So whether it's industrial ETFs or energy ETFs, you don't have to go out and buy each energy stock. You don't have to go out and buy each industrial stock. You can just buy an industrial ETF and you can have skin in the game on each stock and not have to worry about doing all the grunt work. It's awesome. So those are all the pros of ETFs. Now let's talk about the cons of ETFs. And the first con of ETFs is what I kind of discussed before, is that actively managed ETFs do have higher expense ratios. Obviously, they're actively managed. You have to pay a money manager. That's going to cost more money because they have a salary. And typically these do perform better than passive managed. So you are getting what you paid for. But just keep an eye out on those expense ratios because that's somewhere that you can really increase your ROI. Another con of ETFs are single industry ETFs. Obviously, it's single industry. It's going to limit your diversification. And this one kind of does play in with the pro and the con. It's a pro because it can give you skin in the game in the industry and have you everywhere. But at the same time, that's going to lack diversification because in 10 years from now, if everybody's like, you know what, F all the industrial companies, sell it, they're all going to go bankrupt or whatever, and you're in industrial ETF, your ETF's just going to, and I mean, you have nothing else in that ETF to combat what you're about to lose. And the third con is ETFs tend to have a lack of liquidity. And now we saw in mutual funds, they hoard cash to have liquidity so they can always buy and invest in more things, but it limits the amount that you can actually earn on your money since it's being held in cash. ETFs, on the other hand, tend to not have a large cash balance. So all the cash in the fund is being worked. But if there comes an opportunity in the sector or something along the lines with the ETF, then the ETF is not going to be able to jump on that opportunity because they don't have any liquid cash to buy in. So that's basically everything you need to know about ETFs. Now we're going to talk about index funds. And the thing about index funds is that index funds do really kind of bleed into ETFs because most index funds are ETFs. But index funds track a stock index, so like the S&P 500 or the Dow Jones. So if you didn't know, S&P 500 has the largest 500 stocks in America according to their market cap, and then Dow Jones has the 30 largest industrial companies inside of that index. So that ETFs or mutual funds can basically buy in and structure their fund exactly the way that the index is, so that whatever happens to the S&P 500 or the Dow Jones, you're going to reap exactly what it's producing. And obviously Dow Jones only has 30, so the diversification is a lot less. But the S&P 500, which almost every single financial head talker like myself or anybody else out on YouTube is always going to tell you, invest in the S&P 500 index funds, is because it averages about 8% a year and it's really good and it's passive. You really don't have to do anything. Just let it grow. ride the bull market, weather the storms of bear markets, and by retirement, you'll be okay. It's literally one of the best options for anybody that really doesn't want to risk their money in actively trading stocks. So let's talk about the pros of index funds. Number one, ultimate diversification, right? Especially if in the S&P 500, that's 500 different type of companies you're invested in. It's amazing diversification over different sectors, industries. It's a great way to just diversify your portfolio without having to do anything. Number two, low expense ratios. This is because they're passively managed, so you're not paying somebody to actively manage your portfolio. And like I stated when we were talking about ETFs, the Vanguard S&P 500 index has a 0.03% expense ratio. It's like nothing. Number three is they provide strong long-term returns, like the S&P 500 index, 8% on average. Now, some years were negative, some years were 20-30%, but on average, it's roughly 8% return on your money, which is absolutely amazing. And the fourth and final pro of index funds is that it is ideal for long-term passive investors. If you're out there and you're working a job and you just want to invest for retirement, putting your money in index funds is the best thing you could possibly do, because all you have to do is have it automatically taken out of your check, invested into the index fund. You don't even look at it. Just by the time you retire, you're going to be set. Now, on to the cons about index funds is that they are susceptible to market swings and market sentiment. So when markets start going down, the S&P 500 is a large portion of the US market. So if the US market is doing bad, then the fund will do bad because it is tracking the market essentially. But just a keynote on that, never sell. Buy more when it dips. I'm telling you, that's the way to go. So the second con is that there's a lack of flexibility. So because they track an index, there are only limited to the companies inside that index. So if there's ever opportunities that arise, potential 10 baggers or 20 baggers in the market, your index fund's not going to be able to capitalize on that opportunity because it's stuck on just the index. So there is a bit of a lack of flexibility with index funds. Third con is that there's no human element. I mean, you can debate this because, I mean, it's just not actively managed, and some people like their money to be actively managed. They like to have somebody to call and be like, hey, what's going on with my money? So I guess it's a con for some people. For me, it's not, because I don't really have to call somebody to ask them, why am I losing money? But some people might, so I'll add it as a con. And the fourth and final con of index funds is that they do have limited gains. You know, you're not going to have a S&P 500 index or a Dow Jones index give you 100-200% return in a year. It's not going to happen, right? These are huge companies. They're well established. They've already really gone past their growth stage, and they're more in going into the cash cow stage. So you're not going to get hella returns, but you're going to get solid enough return that over time is going to treat you right. So that's it, guys. That's mutual funds, index funds, ETFs, everything, pros, cons, similarities, differences. I hope this video added some value in your life. After watching this video, let me know down in the comments which fund that you prefer. I personally prefer ETFs, and more so index funds with ETFs. I love investing in VTI as well as Vanguard's S&P 500 index. I love it. I think they're awesome. But let me know what you guys think. If you enjoyed the video, please smack that like button right on the ass, and feel free to subscribe. You know, we put out financial content every single week just to boost the financial literacy of everybody. But once again, thank you so much for watching. I'll catch you next time.